The next type of risk that we'll deal with is called credit risk. We will deal more in greater details about this type of risk later on in the course, but right now let's define what is credit risk. So there are three types of credit risk in general: default risk, credit spread risk, and downgrade risk. First of all, default risk. Default risk is the risk that the issuer of the bond will fail to satisfy the terms of the obligation with respect to the timely payment of interest and principal. Simply, if the issuer cannot service the debt, cannot pay back the debt, in other words, either the coupons or the par value or both of them, on time. Second component of credit risk is called credit spread risk, and it is the part of the risk premium or the yield spreads attributable to default risk. This is called the credit spread. Usually we measure the credit spread over some benchmark. Usually we take the treasury bonds, treasury notes, or treasury bills, and we just match the time horizon to your bond. That's the credit spread. It's the extra return that we're expecting to receive from the risk-free interest rate from treasury bonds, and by that we measure the credit spreads. The risk here is that an issuer debt obligation will decline due to an increase in the credit spread. Okay? So whenever the credit spreads widens, increases, the gap between the return on your bond and the return on the treasury bonds, then the higher the return, the lower the price, and obviously if you are not going to hold it until maturity and you will have to sell it at a lower price prior to maturity, this is obviously a risk. You might lose money. The third type of the third component of credit risk is called downgrade risk. This is simply the risk associated with a credit rating downgrade. If a credit rating agency, it could be Standard & Poor's or Moody's KMV or Fitch Rating or any other credit rating, will decide to downgrade your credit rating, this will obviously affect the yield to maturity on the bonds. With a lower credit rating, the higher the yield to maturity and the lower the price. So if those external companies, credit rating agencies, decide to downgrade your credit rating because of some reason that they think that you deserve a low credit rating right now, obviously it will push the yield immediately up because people observe those credit ratings and interpret them into actions. The yield will go up and the price will come down. Once again, if you have to sell the bond prior to maturity with a lower price, you might ending up losing money. Let's see some changes, possible changes to credit spreads. Okay, if we'll put the yield to maturity on the vertical axis and the maturity of a bond on the horizontal axis, a credit spread is the gap between treasury security, which usually have this kind of yield curve, upward sloping concave function, and the credit spreads for any kind of bond, let's say AA corporate bond, is the gap, which means by how much the gap is measured for each and every maturity. This is called the credit spread. Let's see historically what happened to corporate credit spreads in the US. So here there is a timeline from 1997 all the way to 2013. And you see that in the blue line you have investment grade bonds. And with the red line we track here high yield or junk bonds if you want. Low credit rating bonds are junk bonds. So, and they are measured by basis points above the US Treasury bonds, okay? So clearly for junk bonds, for high yield bond, or if you want low credit ratings, the credit spread is much, much bigger. And they tend to shift, I will say, with some correlations to investment grade bonds, but more aggressively. So whenever the spreads go up, they will go up even more. Whenever the spreads come down, they will come down even more than the investment grade bonds. We're talking about the spreads above the US Treasury bonds. Here is a table that will summarize usually how credit rating agencies rate your credit ratings. And we have here the three major ones, the S&P, Standard & Poor's, Moody's or Moody's KMV, and Fitch Ratings, which is a subsidiary of the French bank. It is still working operationally, but definitely S&P and Moody's are the biggest players in this market. They are the biggest credit rating agencies. So most of the time we should see something like AAA, AA+, AA minus, A plus, A minus, and so on and so forth, all the way down to default. D represents here default, okay? Most of the time we say that the threshold between investment grade and speculative grade or non-investment grade, if you want, the lower half of this table, those are the junk bonds. So most of the time we say that anything BB plus and below are considered speculative grades. Okay? This is the threshold that we divide between investment grade. Why this threshold is important? Simply because many mutual funds that invest in fixed income, they have to invest only in investment grade bonds. This is kind of by law or by their prospectus. What they promise to their investors, okay? So this is why this threshold between investment grade and non-investment grade is important. Obviously, the higher the credit rating, the lower the risk, the lower the yield, and the higher the price that those bonds are issued. The next type of risk is called liquidity risk. Let's understand what is liquidity risk. For investors that intend to hold their bonds or debt portfolio until maturity and need not mark their positions to market, liquidity risk is not a concern. So if you intend to buy the bond and hold it all the way to maturity, so you know exactly at what point you buy, at what point what you will collect the par value and the last coupon, and that's it. You don't care about liquidity. But liquidity could be a concern for people that trade bonds more often. Institutional investors that need to periodically mark to market their position, in other words, revalue the securities based on current market prices, liquidity risk could be a concern. Why is that? Mutual funds, for example, are required to mark to market at the end of each trading day to compute the fund's net asset value. And they need to consider what is the liquidity of the bonds. Some bonds are liquid, some of them are not very liquid. People don't trade them very often. And in this case, if those bonds are not traded very often, it's not so easy to calculate what is the actual fair price for the bond. Simply because the actual fair price of a bond, you can get that only if you're able to sell it. If you're not able to sell it, if something is non-liquid, then you don't really know what is the fair price. If you'll try to sell it with a forced sale, then you will have to take a discount from the actual price. This is the liquidity risk. So here is a little information taken from Markit. Markit is a source of database for bonds that we as faculty, we use it quite often whenever we do research about bonds, okay? So let's understand how people assess what is the concept, how people grasp the idea of liquidity risk. So it may surprise you, but 70% of, this is a survey that was taken by Markit, 70% of investors believe that the lack of price transparency as a major liquidity risk to the fixed income market. About 1/4 of the people that responded to this survey believe that firms are under pressure from internal risk management groups to document their liquidity risk. 69% of the respondents are reliant on their own investment team's expertise to measure liquidity risk. And the vast majority, 88% of respondents, measure the liquidity of their holdings using trace data. This is, by the way, a good proxy to measure liquidity risk is considered as the gap between the bid and ask spread for stocks and also the volume that is measured for bondholders. Okay, so as you can see, liquidity risk is something pretty vague. It's not very clear. It's not so understandable. What exactly is the liquidity risk? Okay, it's not so easy to measure that. We need to come up with some proxy variables to measure liquidity risk. So it's not a very contingent perception or concept, but in general, we understand that the more difficult it is to buy and sell something, the lower the volume there is in trading some security, the higher the liquidity risk.